Welcome to U.S. and World Politics Decoded, your source for in-depth analysis of the political and economic forces shaping our world. Today, we're diving into a significant development in global trade and energy markets: the halt of U.S. liquefied natural gas exports to China, following Beijing's imposition of tariffs. This move, while perhaps not immediately apparent in its impact on trade flows, signals a deeper trend in the ongoing economic decoupling between the two global powers and highlights the shifting dynamics of the international energy landscape.
On February 10th, China implemented a 15% tariff on U.S. LNG shipments. According to ship tracking data, this tariff has effectively stopped China from purchasing liquefied natural gas from the United States. This action is the latest indicator that Beijing is continuing to disentangle its economy from that of the United States. The data reveals that China's imports of U.S. LNG had already experienced a significant decline in the months leading up to the tariff, specifically from November through January. This suggests that the tariff, while a definitive barrier, was placed upon an already shrinking trade route. Instead of relying on American supply, China has increasingly turned to other sources, most notably Russia. Last year, Russia supplied China with 4 times the amount of LNG that the United States did. This pivot towards Russian energy is a critical element in understanding the current geopolitical and economic realignments. The global energy market has been significantly impacted by the conflict in Ukraine and the subsequent sanctions and boycotts against Russia. Europe's decision to reduce or halt its purchases of natural gas from Russia since the 2022 invasion has had a profound effect. This boycott has led to Russian gas being sold at considerably lower prices as it seeks new markets, while European companies have been compelled to pay substantially more for gas from alternative suppliers, including the United States. This disparity in pricing has created an opportunity for countries like China. Chinese electric utilities have capitalized on this market condition, finding it significantly more economical way to procure large volumes of gas from Russia rather than the United States. This purely economic decision, driven by favorable pricing from Russia, contributes to the decline in U.S. LNG exports to China, independent of the recently imposed tariffs. Interestingly, even before the tariff took effect, Chinese energy firms that had contracts to buy LNG from the United States were not necessarily bringing all of that fuel to China. Instead, these companies were redirecting their purchases from American ports to Europe, where they could sell the gas at much higher prices. This practice underscores the fluidity and opportunistic nature of the global LNG market, where traders can buy in one market and sell in another for a quick profit, influenced by regional price differences. As Gillian Boccara, director of the LNG team at Kepler, a Belgian energy data company, noted, with energy prices in Europe being so high for American gas, it didn't always make economic sense to transport that gas all the way to Asia. She stated that the tariffs are not really affecting the trade flows in terms of where the gas ultimately ends up. While the immediate impact on trade flows might be limited due to the existing market dynamics, the tariffs could still have detrimental effects on the American LNG industry in the long run, according to Boccara. One significant impact stems from President Trump's tariffs on imported steel. These steel tariffs increase the cost of constructing new LNG loading facilities in the United States. Building these massive export terminals is a capital-intensive endeavor, and increased construction costs can make American LNG less competitive globally and potentially slow down the expansion of U.S. export capacity. Furthermore, broader American tariffs and the retaliatory tariffs from other countries, including China, could dampen the overall pace of global economic growth. A slowdown in the global economy would likely lead to decreased demand for energy, including natural gas,
which would further depress the market for American LNG exports. It is worth recalling the period following the signing of the trade agreement between Beijing and Washington in January 2020. This agreement led to a significant increase in shipments of LNG from the United States to China. As part of this agreement, China committed to stepping up its purchases of American gas, although the agreement did not specify that the gas had to be consumed within China. Following this agreement, U.S. LNG shipments to China saw a dramatic rise, increasing from 268,000 tons in 2019 to 9.3 million tons in 2021. However, this surge was short-lived. In 2022, these shipments plummeted as the global energy crisis intensified, and gas was rerouted to Europe to take advantage of the high prices there, a direct consequence of Europe's decision to move away from inexpensive Russian gas. Despite the fluctuations, the United States accounted for only a small fraction of China's total natural gas imports last year, standing at just 3%. This low percentage underscores that while the U.S. was a supplier, it was not a dominant one in the Chinese market, making the complete cessation of imports due to tariffs perhaps less disruptive to China than it might initially seem. Interestingly, Chinese energy firms had already established themselves as major players in the global markets for liquefied natural gas approximately 6 months before the Russian invasion of Ukraine. According to an analysis conducted in 2023 by energy analysts at Rice University's Institute for Public Policy in Houston, a small number of Chinese companies, nearly a dozen, were responsible for a staggering 91% of worldwide purchases of LNG under long-term contracts. The experts at Rice University concluded that Chinese companies virtually monopolized global LNG procurement in the final months of 2021. These significant purchases, including many cargoes acquired in the 2 months following the Russian invasion, were then frequently redirected and sent to Europe to be resold for a quick profit. This highlights China's strategic positioning in the global LNG market, acting as a major buyer and reseller, influencing price dynamics and supply routes. In conclusion, China's decision to stop U.S. gas exports through the imposition of tariffs is a multifaceted issue. While it is a clear move in the ongoing trade tensions and economic decoupling between the two countries, the immediate impact on trade flows is somewhat mitigated by existing market conditions, particularly the favorable pricing of Russian gas and the profitability of selling U.S. gas in Europe. However, the tariffs do pose a potential long-term threat to the growth and competitiveness of the U.S. LNG industry by increasing infrastructure costs and potentially dampening global demand. This situation underscores the complex interplay of trade policy, geopolitical events, and global market dynamics in the energy sector. Thank you for tuning in to U.S. and World Politics Decoded. If you found this analysis insightful, please give us a like, share this video with others interested in these critical global issues, and don't forget to subscribe to our channel for more decoded insights into U.S. and world politics. We'll see you in the next video.